You're listening to the SBA Loan Experts Podcast, your source for information, tips, and education on the SBA loan program from SBA expert Chris Hearn, founder and CEO of Fountainhead, the nation's leading non-bank SBA lender. Here's your host, Chris Hearn.
Talk about some of the different types of debt financing, and then, of course, talk about in particular what you guys do. So how should we think about debt financing? What are different ways to do that?
Well, oftentimes it depends on the use of proceeds of the loan. But obviously, there's ordinary conventional banks and credit unions that make business loans. The SBA has gotten rather famous over the last couple of years through the pandemic with the Paycheck Protection Program. So there's a lot of different SBA programs that I think you're going to see more and more business owners and entrepreneurs consider going forward, because unfortunately, there's been a lot of myths and misperceptions in the entrepreneurial community over the years. But SBA really showed itself considerably over the last couple of years with what they processed in helping America's small businesses. So there's just a lot of different options out there, but it really comes down to what's the use of proceeds to determine what's the best fit for a business owner.
So give me some examples of the different types of use of proceeds, and then which type of financing might be most appropriate for that type of use of proceeds.
So something I'm seeing is very popular right now is business acquisition financing as a way to sort of turbocharge your growth. And there's this interesting statistic that about 9,000 baby boomers are retiring every single day for the next 9 years. And why that's interesting to a business owner is that they own 56% of all the small to mid-sized companies in America. So there's going to be a huge transfer of ownership of businesses out there. Not all of them obviously are saleable. A lot of businesses will be shut down, but there's going to be an opportunity for a lot of business owners to consider acquiring another business. It's not just a big business growth strategy. It can be a small to mid-sized business growth strategy. But there's one big problem, which is it's kind of difficult to finance these because oftentimes collateral is probably light. So going to a traditional bank or credit union to do a business acquisition loan is probably not going to be a real wise use of someone's time, because generally they just don't like to do these. They may do much bigger business acquisitions if it's sort of a middle market company, but probably not in this space, call it 5 million or less. So it's really the only options are seller financing, paying cash. And when you do seller financing, oftentimes you're paying up for the purchase price of the business and probably not getting very good interest rates or terms. So that's kind of a negative on seller financing. Or another alternative is actually SBA 7A loans, which is very, very commonly used to do business acquisitions. And most SBA 7A loans are done with a 10-year amortizing term. And it's typically the interest rates are in the 5 to 6%. So it's extremely competitive. Oftentimes it's only 10% down, which again is pretty dramatic in the comparison between an SBA loan and if you were lucky enough to get an ordinary conventional bank loan for business acquisition. Most of those are going to be in the require 30 to 50% down payment, by the way. So there's just a lot of advantages to that. And it's something that I think more and more business owners should certainly consider, at least as a business acquisition use of proceeds. Other uses of proceeds for a business loan, you could buy your own commercial real estate. That probably be very interesting to a bank. They oftentimes will be very interested in that because the collateral is something that they know and they trust. You can kick it and break your toe with it. So you see a lot of banks are interested in commercial real estate. Now, again, you got to compare the different terms for all the alternatives. Typically, a bank on owner-occupied commercial real estate is probably going to require 20 to 25% of a down payment, probably going to have a 15 or 20-year amortization, but also will probably have a 3, 5, maybe if you're lucky, a 10-year term. And what that means is that's when a balloon payment will come due. So you'll have a refinancing situation, which includes extra costs if you're not able to pay off all the principal when the balloon happens. So those are some of the pluses and minuses of a bank. Again, there's some good SBA programs like the SBA 504 program, which is extremely competitive from an interest rate perspective because the SBA actually guarantees monthly bonds on this program. That also requires much less down payment, oftentimes half as much of what a conventional bank would require. That's another use of proceeds and the pluses and minuses of it. So another use of proceeds is equipment financing. Normally business owners will consider equipment leasing, but they're oftentimes having a much shorter term on that, say a 3 or a 5 year term. Some banks will be interested in equipment loans, not all, so you have to check. And then another alternative is SBA financing for equipment, which is typically going to give you a 10-year term, only, again, 10% down, which is very common, and it might be something to consider. Other things like working capital, sometimes business owners will get a line of credit for working capital proceeds. The banks typically are pretty good at this. If it's actually identified working capital, that's probably best put in the SBA category again, because you'll get much longer terms. And the terms matter because it's all about monthly cash flow. If you can stretch the terms out longer, that means the business owner is paying less each month, which means they have more capital to continue growing their business faster. And I think that's usually the name of the game for most folks. So those are just some ideas, some different proceeds. We could certainly get into more, and I'm sure people have other things they'd want to talk about. But that's a pretty good, 4 proceed list for you, Steve.
What would you say is your sweet spot in terms of the dollar amount of the loan that you're going to do?
We like to do loans in the 1 to 5 million space. We have done them up to 25 million. We occasionally will do loans under $1 million, but that's, you said, our sweet spot. That's really where we're at. So that probably translates into a business that's doing at least $1 million a year gross revenue, probably closer to 5 on up. When a company's more than 100 million in gross revenue, they're probably graduated away from us. They're going to be more middle market. There's plenty of banks that'll fight for their business in that space.
We started talking about the business acquisition financing. So at that size, what are the typical types of businesses? Are these service businesses? Are these small manufacturing businesses? What are the types of businesses where you might provide some acquisition financing?
Well, it's all of that you just mentioned. I mean, we've done finance acquisitions of manufacturing companies. We've done a lot of service companies, and it's actually interesting because we're able to do business acquisition financing when there's very little collateral. I'll give you an example. We've done many business acquisition financings with like staffing companies. Well, staffing company doesn't have much in the way of assets that we can collateralize. Oftentimes it's just the people, maybe there's some computer equipment and a few other things, and that's about it. Well, so a bank, generally a bank's not going to touch that, not going to come anywhere close to that. But with our license with the SBA, we're going to be very interested, an opportunity, I should say, that we'd be very interested in, because we're looking at it more from a cash flow standpoint. We're not collateral lenders per se, we're really more cash flow lenders. And so, if it makes sense, they're throwing off enough cash to more than service our proposed debt. That's probably a transaction we're going to be interested in, assuming borrowers have good personal credit and a variety of other things. But yeah, we're not scared of making a loan that are collateral light loans, which most bankers are. So, but we see it all sorts of different types of businesses and industries. And, so long as they're privately held, they're for profit, and they're not on SBA's so-called bad list, like things of a sexually purient nature, gambling and stuff like that, that's probably a business that we're going to be interested in. We don't really have any business that is necessarily on a blacklist that we won't consider.
And I know it's going to vary, but is there a typical range, as we're speaking today, of the interest rate that would be charged on these loans?
Yeah, as I mentioned before, most of them are in the 5 to 6% range. If it's more heavily collateralized, like commercial real estate or heavy equipment, it could be in the 4 to 5% range. Or if it's a SBA 504, at least portion of it will be in the 3s. So very competitive interest rates.
So let's talk for a moment about partner buyout financing.
Oh, yeah, we do those too. Yeah.
Yep. So tell me about that. What are some of the challenges that you see when partners trying to buy out the other? And then tell me a little bit about your part in that process, and what advice would you have for that whole process when one partner wants to buy out another one, because that can get kind of tangled depending on what's prompting the buyout. Any advice on that area?
Well, you're right. It can oftentimes get in a sticky situation, and hence the reason why there's the opportunity for a buyout, right? I guess my advice would be buy them out 100%. Don't let them hang on. If there's a reason why they want to get out and you want to buy their interest, then I would say buy it out 100% of their interest. Don't let them hang around with 1% or 5% or 10%. And if you do that, then yes, you're eligible for financing. If you don't, then it's going to be really tough to get financing for your buyout, because most institutions like ours are going to want to see that, that the old owner is gone, and, we're betting on the new owner, basically, or the existing owner who's taking on a much bigger ownership stake. So That's really it. I mean, we want to make sure that they're capable, they're experienced enough to do this correctly, that, they're not buying out, the guy that was really the brains behind the operation. So, we ask some tough questions in these types of opportunities and these situations. But yeah, that's the only advice I would give. I mean, it makes a lot of sense. If you don't do what I was suggesting earlier in this podcast, and you had to bring in somebody and give them a piece of equity, if you want to get it back, then there's financing options out there. But we want to make sure that you know what you're doing, the business cash flows well, and the deal makes sense to do that.
And in a situation like that, are we talking about a 10% down payment, 25% down payment? I know it varies, but any thoughts on that?
Yeah, typically we're in the 10 to 20% down payment, oftentimes 10%, particularly if it's a stronger cash flowing company and if the borrower has, really good personal credit history historically.
And in terms of the terms of that, the length of that, are we talking 3 to 5 years? Could vary? Or?
No, 10 years is how we do it.
Oh, 10 years.
Yeah. So it's pretty
just
attractive.
10 years period. You're not.
Yeah. 10 years without a balloon. So it's fully amortizing for 10 years. Yeah.
And you pay monthly.
Yes. Yes. We do require monthly payments. Yeah.
No interest only loans for the first year or anything like that.
No. I mean, hey, if we're giving to somebody a 10-year term versus a 2 or 3 year term or paying all in cash, I think that's a pretty good trade-off. Yeah.
Hey everyone, thanks for listening to today's episode. Be sure to subscribe to our podcast to be notified weekly of new episodes, and head over to fountainheadcc.com for more about our SBA 7A and SBA 504 resources. Also, give us a follow. You can find us by searching Fountainhead on any of your favorite social media channels. Thanks again, and we'll see you next week.
Today's episode is brought to you by Fountainhead, the nation's leading non-bank SBA lender. Fountainhead's team of SBA experts will guide you through every step of the process and get your loan closed faster and more efficient than any bank. Apply today online at fountainheadcc.com. Thanks for listening, and we'll see you next time on the SBA Loan Experts Podcast.